Good evening, everyone. Welcome on board with us. I really want to welcome everybody who's joining first time here, and also the people who have been our repeated audience in the webinar perspective. I welcome you from the bottom of our hearts and bonjour and marhaba to our webinar section again once back from PMI UAE chapter side of the things. We are here again to add value to your learning, your knowledge and your skill set. As a part of the chapter activities, we are committed to get all this done from our angle and also to make as much as contribution as we can. My name is Anshul Chaube and I'm your host and webinar host tonight with our guest Tanvi with us today. And also I have been working with Ankur, Joyce, and as well as Amir behind the scenes, who is making all this great webinars arrangement with us all together at the back end. So more importantly, before the other people will join in, one good news is that we are seeing increasing number of registrations coming in the PMI UAE chapter. And I think today's registration number was another astonishing number, which I just been told by Amir is the 360. So we have really touched the 360-degree angle from the left to right and bottom to the top there. We are hoping that we can see as many people who are registered in this today's session as well with us. So let us give us some time. Let them come in for a couple of more minutes. Meanwhile, I encourage all of you to start introducing yourself in the chat and then also make good connections as a part of this networking activity. Specifically, if you are coming from a specific background, industry, where you're joining from, location, whatever you want to share about you in the form of your links and getting connection in that level. So keep it flowing and keep it engaged. And then we will begin in a couple of more minutes now. I'm seeing the people are yet joining with us. So let it go together and smoothly. Meanwhile, coming back to today's webinar topic, I'm really excited and at the same time intrigued. Okay, the reason being very simple, because the topic we are touching today is very near to all of us, because we are touching something which is definitely impacting all our lives, managing personal finances. So who want to be not good at it, right? As a professional, as an individual, no matter we are from finance background or not, everybody need to understand what finance is. Everybody need to understand how finance impacts. We all know about it, but how equipped we are to manage it as a project, and that too bringing the strategic success to our personal finances, because it has a huge impact on our well-being, on our social cause, and even from our contribution perspective, it helps to everybody. So I think this is an important topic, and we are grateful for Tanvi to bringing this knowledge sharing webinar with us. We will lay down the foundation of the personal finance decision making by making the concepts clear with you in the form of inflation, asset allocations, market timing, all these aspects which are sometimes very hard for the people from non-financial perspective. We want to make it a bit easier to you guys. So we are ready to join the session, but let's see how many people have come up so far. Okay, so we have 51 odd so people I'm seeing over here. Let it go through. Okay, I think I'm seeing some chats as well. So let the people introduce themselves, and then we can definitely see that where they're joining from. So if you're joining from some other country, of course, depending on the time zone, good afternoon or good morning in that case. Predominantly, we have the people from GCC area. So we have a very good evening to all of you guys. And of course, the summer is officially on over all of here. So without getting into too much of heat, we want to make sure that this session will make a lot of cooler aspects to your life as well from the personal finance side of the things. Before we take a deeper dive and taking the deeper view with our speaker, I would like to explain some housekeeping notes, which normally we already explained, but just to repeat myself, what we need to expect from this 1 hour or so webinar is that we have a set agenda here today. We would like to give you a brief introduction of our chapter, which is the PMI UAE chapter. Of course, then we will have a short time for Q&A at the end as well, where Tanvi and I will like to definitely answer and respond to the questions, whatever you have from the perspective of knowledge sharing or any kind of concerns or queries around that. We will do our best to accommodate your questions in the time frame. If in case we are not, please feel free to get in touch with the speaker or with us so that we can pass on your queries to the speaker to get them answered. This webinar will entitle you to get two PDUs. Those PDUs will come back to you automatically in your PMI account after a certain duration of a kind of week or 10 days. Apparently, if you have already registered for this webinar using your email address, which should be same when you log in into your PMI account, then it will automatically come to your account that way. We encourage you to post your thoughts on the chat, keep it interactive, invigorating as much as possible. Also, try to make this conversation as much as engaging with all of us. Post your questions in the Q&A section rather than mixing it with the chat section, because sometimes the chats overshadow the questions otherwise. So we have a Q&A section separately for it, and let it go through there. And I see that, okay, I think Arman currently reporting from Toronto. Wow. So I think that really brings a lot of cool vibes to us. Thanks, Arman, for letting us know. We are looking for how many guys now. We have, let's see how many have joined us here. 76 or so people have come out there. Okay, Greece. So we see people started coming from Europe. So from the other side of the things, beside GCC, welcome to you if you're joining us first time. I would like to share my screen quickly so that let me introduce the chapter meanwhile to the people who are joining us first time as well. Giving them brief. And of course, no matter where you are from, you can definitely join the chapter from anywhere as possible if you want to network, if you want to understand what's going on in this region, because PMI is a global organization. So here's my screen to give you the good understanding of our chapter. The chapter is the part of PMI Institute, which has been founded by 1969 by the group of project managers, right? So 50 years now, here we are, which is with the source of knowledge and all the kind of learnings which we have gathered so far in the project management. And with the part of organization, this is one of the best organization to be with, because it is one of the professional organization which will brings you the gold standard of the project management, right? So with that in mind, it's a globally issued standards, credentials. Of course, you get a lot of training, accreditations, and the community engagement as well as a part of it. We also have sponsors, and we publish the research, thought leadership, and knowledge content as a part of the PMI community. Coming to the local chapter perspective, so UAE chapter vision is that to empower and influence individuals with the innovate project economy principles to turn ideas into their reality. To achieve these ideas into reality, we need to work with the mission statement, which goes like to disrupt and create value, to drive the opportunities to the chapter members like you and the partners, to become agile, innovative, and productive as a part of the platform for the growth of project economy there with us. Chapter by the we have a big focus on leading industries and serving the trends. Also, we are serving the UAE aspiring community of project managers. We have the people from all different background, all different segments in the project and program professionals. And then we are giving a lot of weightage to bringing the knowledge back to the table. And then the people who are contributing to it are the valuable asset to all of us. We are dependent on you to make your chapter activities as interactive and invigorating as much as possible by getting into the part of the events, which we normally keep on doing. We did the recently annual gathering as well in the previous quarter. And of course, we keep on doing the other quarterly events and the workshops as well as we can make it possible for all of us. Here is our board. So board is led by Mr. Adil Sultan as a president, and then rest of the board directors with him is contributing on their own functional areas to keep the chapter as much as engaging and upskilling to everybody's contribution. Some benefits of the chapter, if you want to join the chapter beside PMI, you have a networking opportunities, you have a learning and knowledge sharing sessions, you have a career growth. We are planning to do some sort of initiatives around that as well possibly in this year itself. You might hear from us events. So this is the series of the diversified webinar, and we do the tailoring workshop as well as we get into the right kind of people with us. We also give a lot of weightage to the people to give them the platform so that they can share their thoughts and expertise in the wider project management fraternity. We introduce the member corners and the spotlight sections. And as a newsletter, we always features certain members and the people who have been really making difference in the community. And then they have an opportunity to write to us at newsletters@pmiuae.org. If you want to gather some more information about chapter and you have the all social media channels and handles, these webinars are also being recorded. And as usual, we normally post all these webinars into our YouTube channel. You can go and see the recording if in case you miss certain section or you want to revise up what you have again learned today. And then of course you have the certain email groups which you can see on the screen, specifically designed to cater to the requirements of your particular concern matters on the volunteering, general inquiries, or towards the membership side. So with that in mind, I would like to share my screen, and then let me introduce to Tanvi. So Tanvi has been waiting patiently with us. Tanvi Goyal is a renowned wealth specialist, and she's influencer and a speaker. And she's on a mission. Just like UAE chapter has a mission, she has a mission to empower 1 million individual by this year to take charge of their own financial destiny, to become the CFOs, the chief financial officers of their own families. She's an MSc from finance from UK, and then of course done the BCom honors in graduation from the prestigious Shree College of Commerce, New Delhi. And Tanvi has been handling $1 million accounts at the top MNC banks like HSBC and Anand Rathi before launching her own venture, which is Wealth Aware, a wealth management and a coaching firm which she's running out of New Delhi in India. She has been a trusted advisor to the affluent couples, professionals, industrialists, and widely recognized for making finance as a fun and simple subject in the layman understanding. Her work has been featured in Mint, India Today Group, Dainik Jagran, First Post, Money Control, and many other social media platforms as well. A true crusader for financial literacy, women empowerment, she was invited by the United Nations Women Association to speak on the importance of financial planning for Indian women. As she says, awareness is the first step towards achieving your wealth potential. So with that, I would like to give the stage to her and try to learn what she brings to the table, what kind of enlightenment she want to raise in our finances and make ourselves happy and contented. Over to you, Tanvi.
Thank you so much, Anshul, for this wonderful introduction. And I would just like to share my presentation. Are we good to begin?
Yep, we are. We can see a presentation. Go ahead.
Yes. So let's begin by investigating as to when we get the money in our hands after all the hard work that we do, why do we have a need to invest or save that money? So I want all of you to just share your, answers in the chat box with me. Why do you think we need to invest the money? It can be, invested in to various different types of investment opportunities. But what is the need to invest your money? So let's have the answers from everybody. To beat inflation, return on investment, letting your money work while you rest, future, to grow the money, to make more money, secure financial future, our retirement, yes, create passive income, secure future, to make the money work while you're sleeping. Great. So we are on the same platform. The basic idea for you to beat money is that you need to beat inflation. Now, what is inflation? And that's what we need to understand. So inflation is nothing else but the increase in prices. Now, what do you think? Is inflation good or bad? Is inflation good or bad? I want all of you to answer. Inflation good, bad. Okay, we have a mixed response here. So let us understand by a little bit of history that if you all remember, or if you have ever heard of hyperinflation happening in different countries, different parts of the world. So there was an instance of hyperinflation when the prices were increasing, they were doubling every 4 days. This happened in Germany after the First World War because they were printing a lot of money, right? So hyperinflation happened, and in 1 month, the prices had increased by 30,000%. So that was a devastation that happened with the German mark, and they had to introduce another currency. So inflation is good for the economy because the increase in the prices of the assets is great. Because when you're purchasing a house or anything else, you want the value of that house to go up eventually. So inflation is good, but hyperinflation, such as what happened in Germany, is of course bad because the money can lose its value over time very, very fast. Similarly, there are cases of deflation. Now, if you all remember, or if you've ever heard of deflation in any economy, have you guys heard of deflation in any economy? Any country that has gone through deflation? Okay, so there has been deflation in Japan, and this was called the lost decade. Now, it has actually gone for over longer. It has gone for 2 decades or so. It started in the 1990s. And just recently, the things have started changing for Japan. But what happened in Japan was that when people bought a house or any other asset, the price of that asset was actually going down. So there was no incentive for people to purchase anything. So cash became more important to them. So nobody was interested in buying anything. And the government, the Bank of Japan, was actually trying to pay them to take loans so that they could buy something. They were not interested in that, right? So deflation also throws the economy in a very, very low phase. So hyperinflation on one end is quite bad for any economy, and deflation is also very bad for an economy. So what is the right mix for an economy? Every economy is trying to control this monster, inflation, which is bringing down the purchasing power of your money. So every economy around the world, every central bank is trying to just chain that monster. They're trying to control it. So they try to control it and they try to keep it. For example, in India, the mandate of the central bank here is to keep the range of inflation between 2 to 6%. So they always try that the inflation should not cross 6% mark. Now let us see what is the inflation around the different economies. So the number one goal for any investment for your wealth in the long term has to be to beat inflation, right? So you can look at these different inflation figures. USA is around 3.1%, India is 5.7%, Japan is 2.8%, Germany 2.9%, UAE 1.7%, and these numbers, they keep on changing from quarter to quarter. So all these economies around the world are trying to control and keep it chained. And our purpose with our money has to make sure that we beat this inflation, right? So this is the basic inflation which the government comes out with. So these are published figures. They're always available to you. If you just look up on online, you will always get to know what's the inflation in the country that you're making your investments in. So the long-term goal, you can, if you're making notes, I want you all to write it somewhere. The long-term goal for your wealth has to be that it has to beat this minimum inflation in the economy. That's what we should expect. So if I'm investing 100 rupees, for example, in India, it should at least give me more than 5.7% in the long run. Otherwise, it's not even maintaining the purchasing power, right? Now, another thing that we need to be worried about, or another thing that we need to consider while investing our money is lifestyle inflation. Now, what is lifestyle inflation? Can you all think of some lifestyle change that has happened which you cannot really let go of? I'll give you an example. For example, Have you ever felt some technology like maybe Android or iOS? I'm not saying which one is better or worse, but when you switch from one to another, you might just, like to use one over another. So I want all of you to share that one example. It can be either an upgrade of a car that you were driving a certain brand, and then when you switch to another brand, you just cannot drive the older one anymore. It can be about clothing brand. When you start wearing something, upgrade of a house. Yes, Adil, that's an amazing example. When you started staying in a locality also, right? When you moved out of some location where you were not getting the necessary amenities, and when you move to a better location, you just cannot go back. Switch to a muscle car. Okay. Anybody else who wants to share instead of a family car? School, yes. Brand purchases, jewelry, yes. Anything else? Even simple things like the kind of coffee that you drink or the kind of, yeah, salon that you go to. Traveling, of course. Once you start traveling business class, you just don't want economy anymore, isn't it? Yeah, so simple things. So these are called lifestyle upgrades. And this also is kind of an inflation, which is absolutely invisible, and nobody has a lot of calculation around it, right? So it's very difficult to calculate an exact number for lifestyle inflation. It's almost invisible, and nobody really talks about it. But lifestyle inflation is a fact, it is relevant, and we have to make sure that our wealth, whatever we've accumulated so far, makes up for this lifestyle inflation. Apart from the normal inflation in the increase in prices in the economy, which has a number to it, we have to make sure that our money provides for our lifestyle inflation as well, right? So yeah, these are excellent examples. Thank you all for sharing. Health services, vacation in different countries, right? Staying in five-star hotels. Once you start staying in five-star hotels, you just don't want to go to three-star or four stars anymore, isn't it? You get used to a certain lifestyle. Amazing. So that's the point, that we need to invest so that our money can match up to our lifestyle and it can give us the same kind of comforts that we've been used to. So we don't want a situation where we are investing in an economy or in a product, and even the basic lifestyle inflation and the country's inflation is not getting beaten. So let's take a very simple layman example. So if you get an offer by a banker or an advisor to invest into a product, and say you are investing in India, and that product gives you 4% or 5% return per annum, would you invest in it for the long term? A yes or a no? By the simple logic that our wealth, the number one thing that we need to take care of is that it has to beat inflation plus lifestyle inflation. No, right? So this becomes our number one foundation of decision making. So anytime somebody brings to you a product which is not even beating the normal inflation plus a few percentage points for the lifestyle inflation, that means in the long term, it is not a good fit for your wealth, right? Of course, in the short term, there are certain cases which we will just see. For emergencies and all, we need to park into products which might not beat this inflation. But in the long term, this is a very, very good yardstick. And most of the bankers or advisors or intermediaries or distributors, they do not talk about this. They do not talk about the longevity of that product and how it's going to affect your overall lifestyle. Great. Is this point clear to everybody? That what should be the foundation, number one foundation for our decision making? Can I get a thumbs up or yes? Let's go ahead from everybody. Is lifestyle inflation and the government inflation clear? And these numbers keep on changing, keep on varying. So you have to continuously keep yourself updated, like what's the inflation in your economy. in this particular quarter or this particular year. Great. Thank you so much. So let's see what do we have next. Right. So we'll keep this knowledge of inflation and we are going to come back and use it in the later slides. So let's come down to our personal wealth and financial planning. So here we have to, first of all, be ready for emergencies. Like initially, you all mentioned that you want to be ready for retirement, you want to be ready for different, you know, emergencies, any changes in the scenarios, change in job, right? So what are the different kind of emergencies that you all can think of? Can you all share again? What are the different emergencies that can arise? Medical emergencies, yes. Accidents, health, loss of job, layoff from company, yes. Natural calamity, yes. Hazards, situations, war, natural hazards, yes. Wars. Great. So these can be the emergencies, right? Wealth loss due to market crashes, yes. Political instability, demonetization. Yeah, so these kind of emergencies, how do we prepare ourselves for these emergencies? So first of all, the insurance against life. So if you have dependents on you, if you're creating money and you have your children or your elderly parents or your spouse dependent on your income, life insurance is a must. And especially if your employer is not giving you enough adequate life insurance, then you need to have a pure life insurance. In India, this is called a term plan. And in various other countries, life insurance, the pure life insurance, this is called by different various names. You'll have to look it up. Now, I'm talking about the life insurance, which does the simple job where you pay the premium, and for that 1 year of paying that premium, you only get peace of mind, right? Now, there are other kind of life insurance products which are called hybrid products. I am not in favor of purchasing those kind of products because in those hybrid products, we pay the premium, we do get certain life insurance, but we also give them some money to invest at certain places and expect some return, right? So these investment products, they give you life insurance as well as investment. Now, why are they not very, very good? Because they might not give you the adequate life insurance that you need. Secondly, they might not be very flexible just in case you need to increase your cover or you need to get out of it and get a better, life plan. So they lack flexibility. And thirdly, usually they have higher charges, in-bill charges involved, right? So you should look out for pure life insurance, a pure term cover, which is almost like saying that, you how you buy life insurance for a car. So you pay the premium. If anything happens to the car, you get the sum assured, right? Similarly, in life insurance, the pure life insurance, you pay the premium and you only get the peace of mind in return that if anything happens to you, your family will get compensated as per the terms of the policy, right? So that is the best kind of life insurance to have. Then, of course, health insurance. Most of the people these days get health insurance cover from their companies. But apart from what the company is offering, if you feel that's not adequate according to the city that you're in and the lifestyle inflation that there might be, the medical inflation there might be, you can take a additional health insurance cover. Then property insurance, of course, you can safeguard your assets, right, against fire and hazards, natural hazards. Then we come to emergency funds. Emergency fund will make sure that if there's any job loss or if you're changing your city or state or country or any other emergency, then in that duration, you can at least take care of yourself and your family. So ideally, 6 months of your family's expenses should be kept in one kind of asset, which is safe, which does not have market linked volatility, right? Now, this can be interest based time deposits with banks, or it can be the risk free interest rate 10-year bonds of any government, right? Or it can be debt funds. But just in case, because of some religious reasons, some people do not prefer interest-based instruments, then you can go for gold, or you can go for commodities, which is called defensives, such as crude, right? Or you can go for gold ETF funds. So these kind of things can take care of your emergency fund. So are we all clear on how we can plan for emergencies? Let me have a okay in the chat box. Are we all clear with how we can? Yes, great. So let's move ahead and see what else do we need in a good financial plan. Now, apart from all these emergency planning, we need to have a good asset allocation with the rest of the wealth, right? Now, what do we mean by asset allocation? It is nothing else but the various assets and how much percentage we have divided into various assets. So for that, we have to understand that, okay, yeah. So for that, we have to understand that what are the different asset classes. There's equities, there's real estate, and uh, there's cryptocurrency as well. So equity, real estate, and cryptocurrencies, these can become the different assets that we have for long-term wealth management. Now we bring back our knowledge of inflation. So from all this money that we're going to allocate into different asset classes, what should be the minimum expectation for the long term? What do we have to beat? What's the word? Your normal inflation and your lifestyle inflation. So that can become the minimum expectation from this wealth, which we are going to allocate smartly over different asset classes. Now, real estate is something which I'm not going to speak too much about, because you guys being in UAE, you are already mastering the real estate game. I'm going to primarily talk about the equity markets, the stock markets, right? Are you all game for the stock market? So, right, bring it on in the chat box if you're all game for the stock market discussion. Yes, VIO, bring it on. Awesome. So to understand the stock market, the foundation of the stock market, we have to first make sure that we understand the ABC. And the ABC of stock market starts with the index. Now, you've heard of these terms before, I'm very, very sure, because the moment you open the newspaper, the first section is always about the Nifty, the S&P 500, the Nikkei, or the Hang Seng, right? So we've heard these terminologies, but do we actually understand the relevance of what an index is? So what an index is? An index is nothing else but a basket. Now, in that basket, we can have 500 S&P top 500 large cap stocks, or in Germany, there are the top 40 companies. In India, Nifty 50. When we talk about the Nifty 50 index, this basket, it has the 50 leading Indian companies. So similarly, the different stock exchanges of different countries around the world, they have their index. Now that index is the criteria to set that index is set by the stock exchange itself. And usually it's a dynamic basket. So for example, the Nifty 50 in India, there the top 50 companies are there, right? However, if one of the companies whose shares are in that basket, Nifty, if they stop performing well, it will get pushed out, and the company which is sitting at 51 number, that will come and take its place. So that's why Nifty is a forever changing basket. So at any point in time, this basket is going to have the top 50 companies. Similarly for S&P, similarly for DAX and Nikkei, right? Is the index clear? What is an index? So we have to understand why index is important. So whenever we are investing in a mutual fund or any economy, we have to understand that that mutual fund is run by a fund manager and his team, right? So they are using their intellect to find the best shares, to find the best company stocks to put in that basket to offer to you as investors. Now, that mutual fund will compare its performance to the benchmark. And the benchmark is either this index, which is for the main broader economy, or a similar kind of benchmark for the relevant stocks. For example, if you're purchasing the top companies, which are called large cap companies, then the benchmark can be Nifty. Or if it's going to be mid cap companies, if you're purchasing a mutual fund for mid cap companies, you're going to check the performance of that mutual fund vis-a-vis the uh, benchmark, which is for mid cap companies, right? So small cap companies also will have small cap Nifty as the benchmark. So these indices, they become the benchmark to understand how our fund is performing. Now, is there a way to invest into these indices? Yes, that's called index investing. So how good, bad, or relevant is index investing? Now, this index investing is for people who are beginners and who do not want to try to time the market too much, and they do not want a very high cost. So index investing means that you are basically investing in a mutual fund, which is just replicating the index of that economy. So for example, if you want to invest in US, you can just purchase an index which replicates or mimics the S&P Dow Jones, right? Now, what's going to happen? The average return of the S&P 500 companies will get reflected in the returns of that mutual fund. Now, what is the benefit of these kind of passively managed mutual funds? They are low in cost because the fund manager is only mimicking the index. He's not using his intellect. He's not using his team and the brokerage and the different reports. So basically, they're not using too much information to buy and sell the stocks. They're only tracking the companies and offering them to you as an investor, which are part of the index, right? So that's why it has a very, very low cost. Secondly, you get the benefit of diversification. You don't have to sit and select the companies that you want to invest into, right? And of course, it tracks the market. So you are invested into the broader market. So this is called passive investing. And John Bogle was the father of index investing in the US. He pioneered it. And I'm sure you've heard of the name of Vanguard. They have these index ETF funds, which are very, very low cost in the US. So the interesting point is that one of the best and most famous investors in the world, Mr. Warren Buffett, he had this bet with the hedge fund managers that for the longest period of time, I think he took it 10 years, the index fund would outperform any other mutual fund or hedge fund. So he had this challenge, open challenge. And actually, after 10 years, the hedge fund managers in US, they conceded that yes, we were not able to provide higher returns than the index. So in the US market, it became very apparent that generating alpha means that returns which are higher than the index. So in the US market, alpha generation had become very, very difficult, and any other mutual fund manager was not able to deliver alpha over a very long period of time. So within short periods of time, in those brackets, people were able to deliver higher returns than the index. But in the long periods of time, it was not possible. So the US, where 70% of the population invests into the stock market, into the equity markets, there alpha generation has become very difficult and index investing has become very, very popular. So if you are investing there, this can become a very easy method for you to invest into the stock markets. So you can just replicate and start investing into a mutual fund, which can be an index mutual fund. And you can do it directly without any broker or advisor through the various platforms available to the US investors, right? Now, coming to the Indian context, this alpha generation is pretty much possible in India. And you have to basically reach out to the right financial advisors, and they can give you a bouquet of mutual funds which can collectively create an alpha. So this is the way you can judge whether the financial advisor or the banker is doing the right job for you or not. Because a lot of times you feel that, okay, fine, the returns are decent, but decent as compared to what? You have to see that the returns overall of your mutual funds are beating the benchmark, right? That is called alpha. Okay. So now I just want to bring your notice to Warren Buffett's portfolio. So I'm just going to take you to his website. Great. So you know Warren Buffett is one of the most inspiring investors in the world. So let's have a look at his portfolio. Can you all see the screen? Please give me a, thumbs up in the thumbs up or yes in the chat box. You all can see the screen. Okay, great. So when we go to Berkshire Hathaway, which is his company, investment company, you can just go to Warren Buffett's letters to the shareholders and probably go to the 2024, which is the recent last letter. Here towards the end, you all can see what is the annual percentage change in S&P 500. So S&P 500 is the benchmark he is measuring his own portfolio's performance against, right? So you can see that how this stock market gives you returns. This is very, very volatile. It keeps on changing, right? So let us come down to the end so that we have the average. Now here you all can see his portfolio has given a return of 19.9%, and the average return, the average annual return of the index, which is his benchmark, he's comparing his performance to the S&P 500, has given 10.4% average annual returns, right? So this is called alpha, the additional return that he is able to generate vis-a-vis the benchmark. So index investing means that you can just invest into a normal S&P 500 and you can get the same returns that S&P 500 companies are giving at low cost, and you will not expect any alpha. But when you're investing with any other mutual fund manager, then that means you need to have certain alpha because there will be an additional cost or that they will be charging to you. And there can be a huge difference between the costs. Just as an example, in the Indian context, an actively managed mutual fund can charge you 1.5% annual fees, whereas an index fund, which is called passive style of investing, may just charge you 0.18%, right? So that can be the level of difference in the cost. So 19.9% vis-a-vis 10.4%. That is how we measure the alpha. And this is what you need to see when you're speaking to your advisor or your banker, that how much alpha they are giving to you through their fund selection. Now, this also gives us an estimate of what is the higher upper range of investment. So we know that the minimum expectation that we should have from our money is to beat inflation, whichever inflation number is relevant to you in your country. And the higher inflation number, the higher expectation from your wealth can be as much as Warren Buffett is making. If he is one of the best and the most famous investors in the world, then you can expect, okay, 18, 19%. If Warren Buffett is getting 18, 19%, then anything between my inflation beating number and that becomes your expected range from the stock market, right? Okay. So far, are we clear on these concepts? What's the minimum expectation that you can make while making a decision about investing into the stock market? And what's the higher expectation on the higher range you can expect while making a investment? So it would be unfair if you're expecting, say, like a 50% return or a 60% return. So you can always think in the lines that, okay, if Warren Buffett's investment is giving a 19% per annum kind of return, then anything higher than that is probably taking a lot of risk. So with are you okay with that kind of risk? But if you're just intending to invest in the stock markets and nothing extraordinary return giving opportunity, then that means Warren Buffett's portfolio can give you the higher expected range. So what is the best part about investing into the stock markets? First, of course, we can invest through index and we don't have to care about picking up the stocks. Then the other option is we can invest through mutual funds where the fund manager is doing the stock picking for you. But there is the magic of compounding. So compounding basically is the eighth wonder of the world. And here, timing is very important. The longer you let your investments be into the markets, the higher your returns are. And for that, let's just take a few examples. I'm just going to take you through my Excel sheet. Okay, I hope you all can see the Excel sheet here. Please
Yes,
type a
Tanvi.
yes in the chat box. Great. So here, let's just take an example of that. You've invested, say, $10,000 into the normal index through the index fund. Okay. So you don't have to worry about stock picking, timing, anything. 10,000 bucks invested into the stock market, giving you, say, 10% returns. Or we can say 9%, right? Let's just assume 9% return. So if you let it be for 10 years, 1.09. Okay. vis-a-vis 10,000 invested for 20 years. Yeah, there you go. You can see the difference. So compounding happens when you're getting the same return and return over those returns. So in 10 years' time, that $10,000 will become 21,718. But in 20 years' time, it's going to become 51,416. Similarly, if you keep on compounding and if you keep on seeing for 30, 40 years, the similar returns will keep on compounding. And the higher the number of years you're invested into the markets, the better the returns, right? So that's compounding. And Warren Buffett is a very, very strong proponent of compounding. So how can we time the market? Can you please share the... Are there any questions so far that we can take? Then I can move on to the next part about how we can time the market and other more complex things.
Tanvi,
So far,
we have
so
three
far we've just
questions.
understood how we can create emergency funds, how we can invest into the stock markets, and through the index investing. And if we are not using passive method in active investments, what do we have to look for? What is alpha generation? So I hope that much is clear with everybody. Now we are also going to see how to make investments through monthly automated way and the other options that's clear. So I hope all of this is clear to everybody. Are there any questions that we can take at this point in time, Anshul?
We have the questions, Tanvi. Can you hear me?
Yeah.
Yeah, so
Let's
we have
take
the
those questions.
questions, but they are specifically not something which is might be the, for example,
Okay.
they are general questions. We can take it up at the end after this.
Let me take them right now, and then we'll just
Okay.
move
So
on to
then the
the...
first one, we can take it from the perspective of what is the best period to hold in a mutual fund investment typically?
Thank you, Mr. Thomas. So what's the best period to hold a mutual fund? The best period to hold a mutual fund depends on your goal. For example, if your goal is 10 years down the line, or your goal is 15 years down the line, what you're going to do is in the equity mutual fund space, when your goal is nearing, just 2 years before that goal is nearing, you will start monitoring the markets. And if you feel that the PE ratio of the market is very high, the market cap to GDP ratio is also on the higher side. That means the market valuation is on the higher side. That's when you can take out your money and park it in a safe haven product, which we also used for emergency planning, right? Something like a fixed deposit with a bank, which is also called a time deposit, or something called a debt fund, which are not volatile, right? And if your goal is 15 years away, then you start doing this job on the 13th year. So 2 years before your goal, you start monitoring the market. And whenever the market valuation is on the higher side, you just sell your mutual fund units and you put it in a safe haven debt product. Have I answered your question, Mr. Thomas? Okay.
Yes. He has
Okay.
said yes.
Thank you.
So that's good. We have another question, Tanvi, is that from Ashraf is looking for that how the personal finances should be managed in a partnership business. So without, of course, without impairing the transparency and other aspects of partnership.
Right. Great question again, Mr. Anjum. In a partnership firm, we are talking about personal finance. So in a partnership firm, the money which is in the partnership, you can have clear mandates that how that money has to be managed or invested. For example, the partnership firms that we invest for, they have clear mandates that, they cannot invest into the equity markets, or they can invest into the equity markets, or this is how it has to be invested. But when it comes to personal finances, it has to be in accordance with your goals, your family's needs and requirements, and your perspective, your risk tolerance, right? So personal finance management can be completely different for each partner of that business. Have I answered your question? Mr. Anjum, have I answered your question correctly? Okay. Anyways, so
Good.
let's
So
go on to
Tanvi,
the
we
next
have
question.
another question.
Hmm.
Yeah, how to forecast and measure your ROI at the monthly and yearly expense levels?
So return on investment is not on the expenses, how to forecast and measure your ROI on monthly and yearly expenses. So the return on investment is on the invested amount. Uh, Maybe you want to reframe this question again. Can we ask the gentleman to reframe the question
Tanvi, your
again? Because
sound is,
my sound is jarring. Is it breaking?
yeah, it was breaking in between. Not sure is it my internet connection or is it yours, but I was not able to hear you in between. Question was how to forecast
Hmm.
and measure your ROI on monthly and yearly expenses.
Okay. So I think they want to ask about the investments, because the return on the investment is on the amount invested. It's not on the expenses. So they are two different things, right? We can have our expenses, and we don't calculate the return on our expenses. The return is calculated on the investments. Now, how to forecast? You don't need to forecast, you just need to measure, because now you know that you know what is your expectation from your wealth, the minimum expectation from your money, and the higher upper limit which Warren Buffett is making, right? So you know that you know the ball game is between this, and this is what you want your money to do for you. So you can measure the ROI on your investments with the help of the reports that are generated by the asset management company, or your advisor or broker can also give you the uh, reports. So in that report, you will see the section which talks about IRR, right? So you can have that IRR section where you can talk about where you can see the internal rate of return of your investments. So IRR is the way to measure your investments. Great. So now we move on to, we jump back to the presentation. Now, to understand how to time the market, we just have to understand this one little concept. So this is how the stock markets function, right? And you've seen that the S&P is given 10.4% annualized return. The Indian stock market, say the Nifty 50, has given 16.8 annualized return since inception, right? But it doesn't come to you in a fixed pattern like the debt instruments, which are interest-bearing instruments. So how do we, make sure that this volatility doesn't affect us? So when we make investments into mutual fund, then we can use an automated method, which is called systematic investment plan in India, or regular investment plan in the US, right? So what are these plans? That in an automated way, every month you pre-decide the amount, and the bank will debit that amount and invest it into the mutual fund of your choice. So the broker or advisor, they can select the stocks for you. Or if you're doing it directly, then you can just go for passive index investing if you're a beginner. So in an automated way, what happens is you are making the investments even when the market is on the lower side and even when the market is going up. So you don't need to time the market. Now, what is the beauty of this method? It gives you rupee cost averaging or dollar cost averaging. So what happens in dollar cost averaging is that whatever money you are investing, you're collecting units of that index or you're collecting stocks even when they are cheap and even when they're expensive. So on an average, the value that you're collecting, you get a good average basically, right? So when you're getting a good average, you don't have to think about timing the market. You don't have to worry whether the value of the market is cheap or expensive. But the other method, if you want to ascertain when to invest at the bottom and when to exit at the top, that depends upon various factors. One of the simple method is market cap to GDP ratio. So if you see the market cap to GDP ratio, and if that ratio is lesser than say 0.5, even if it is 0.7, then that means it is a cheap market and you can invest. And if that ratio is on the higher side, say more than 1, then it is an expensive market. So this is one of the methods. Apart from that, there are various other methods to try to ascertain the value of the market, right? So don't just go by this one particular method. This will give you a very vague idea. The other methods are with the help of using PE ratio and the earnings growth of the economy, right? Anshul, I think it would be too much if we delve too much into the details of these concepts. What do you think? Do we have the time for that?
No, actually, we are already finishing up the time. So I don't
Okay,
know how many more slides you have or how much we are in the total flow over here.
we can wind up now. So
But we
yeah,
can
so
conclude
that's
on
how
some
we
logical way.
basically invest into the stock market. I think for a beginner, we have pretty much understood how to create emergency funds, how to take care of our expectation from our wealth, how to invest into the stock market in a passive way, in an active way. So yeah, that's about it. And also about cryptocurrencies, just a last note that, just like how we do not eat certain things as a major portion in our meal, we might not eat like that wasabi, too much of that wasabi. So similarly, cryptocurrency is just speculative in nature. It is not considered as an investment, it's considered speculation. So we should limit it to a small amount in our portfolio. So just make sure that you keep a certain percentage according to your risk appetite and do not exceed that percentage when you're investing into the cryptocurrency markets.
So Tanvi, I'm seeing some questions is that, of course, I'm not sure whether you would be able to answer from the Islamic funding perspective.
Mhm.
Sharif is trying to ask you that any Islamic funding or stock markets you can guide us to invest towards?
So in Islamic banking, my understanding is only limited to my dissertation when I was doing my MSc Finance in the UK. But I understand that interest-based instruments are are prohibited, right? So you can invest into the stock markets, and for stock markets, the best thing for beginners is to do passive investing, right? So you don't have to worry about timing the market. You don't have to worry about selecting the mutual fund. You don't have to worry about, which countries the markets are going to do better. So you can invest into stocks, which are basically participating in the business workings of a company.
Okay. Okay, thank you for that. Can you also touch slightly, I don't know whether it will be possible, but uh, P ratio, you just was touching at the very last. P ratio, can you just explain in the very short form perspective that how a layman should understand and take a clues from it?
Yeah, so PE ratio should not be used as an absolute ratio. So for example, if the PE ratio of the index is low on the lower side, you can see, you can try to understand what is the general range of the PE ratio of a country's index, right? So if the PE ratio was on the lower side of that spectrum, that means the valuation of that index is on the cheaper side. And if the PE ratio is higher, that means the valuation of that index is very expensive. So, but I think it will take much longer for me to get into the details of the PE ratio and what it is and how we should use it.
So certain people have the confusion about AI also. So how can we leverage AI? I think this is something that you would like to say that we need to keep it a separate session specifically for you with the AI leveraging. Uh,
Yes.
what's your, you can conclude it with that because some people have a confusion that how we not touch the AI in the session here.
Sure. So, the power of AI is that it can help you with your personal finance uh, numbers. For example, if you want to understand that today your child's education costs an X amount. So what will be the future value of that? What will be the future expected cost of that particular goal, right? And then it can help you to ascertain that if you invest in A option or B option or C option, then with the help of expected returns, it can help you to come out with those numbers that, okay, you can invest so much amount and it will reach the expected future value of that goal, right? So it can help you in these kind of financial planning. But I did not share it here because I think, again, like Anshul said, it requires a lot more time. And also it's country specific because every instrument, every country will have different kind of returns associated with its debt instruments, with its equity instruments, right? So you need to have prompts separate for each country. So I
Mhm.
cannot just offer the generic prompts. It has to be country specific where you're intending to invest your money into.
Sure. Thanks. Really, I think that was very important to understand because that is a very new area from the perspective of field, and apparently the wrong use of AI can really do a loss rather than making and thinking that we are going the right direction even. So sharing wrong information or partially correct information is definitely not a good idea from the perspective of general favor. So I think that really requires you the specific perspective. Might be in the further sessions if we can go and collaborate further, then we can create a curated session only for taking the examples of country specific areas and
Yes.
picking up AI, then how is it used in this area, in this country, and versus another part of the country which is very different from it. That will give the perspective of AI to be leveraged around, possibly. But yeah, I think that was really a good, wonderful session. It really brought us closer to the perspective of the people who are a bit away from the understanding of basic financings and the cover shields, what they need to have bare minimum, how is it the leverage need to be managed from the perspective of mutual funds and other ratios, what you were just explaining around that. It was really great. And I think once we're going to close the webinar, definitely I want to like to say a big thank you to you, Tanvi, to bringing us and then sharing your perspective. And then also a good thank to the people who are attending this session and their participation in the questions, which will really brought us a much more closer to the perspective of closure here. I want to thank the rest of the PMI chapter volunteers and definitely the people who have been successfully behind this webinars from the membership outreach, volunteering and finance governance perspective. Also, big shout out to marketing team because without them, we are not going to get this understanding that what events is happening, and to all of you to keep you update from the perspective of YouTube channel and all the social media handles as well with us. So we are going to close for today until we meet our next webinar. We are going to close for today and call off. Me, Anchal here behind the camera, Ankur, Joyce, and Amir will say sayonara and good night to all of you. Have a pleasant evening ahead. Thanks, Tanvi, and all. Take care of you.
Thank you.